Hello, and welcome to the February 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within the U.S. and global energy, and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will focus on recent movements in the global crude seaborne exports and onshore inventories, China crude imports and outlook, Greek operators leaving the Urals trade, and U.S. Gulf Coast clean product exports. OPEC Plus crude exports plunge nearly 3 percentage points in January month on month. Not only have we seen a big drop in OPEC Plus exports, but also declines from other key suppliers, including the US, Norway, Brazil, and Mexico. All have dropped significantly since December. OPEC Plus cuts have translated to lower seaborne exports since October 2023, working to tighten the global oil market. Vortexa tracks over 110 onshore inventory tanks for crude, and you can see here that tank utilization has fallen by 6 percentage points when compared against the 8-year average, providing price upside. Now, the majority of this decline was driven by the Americas as they sent barrels to Europe instead of Asia. Despite what most may think, the Atlantic Basin crude exports have remained mostly unaffected by the security risks in the Red Sea. Most of the crude goes to Asia via the Cape of Good Hope, with the exception, of course, of Russian crude. The key factor driving this decline in Atlantic Basin exports has been the lack of Chinese buying, visible in the red line. Chinese crude and condensate imports have been declining since October 2023 and have failed to pick up even after issuance of a full-year crude import quota to their refineries. With slowing demand from Asia and upcoming spring maintenance in Europe and the US, it does remain to be seen if or whether these Americas barrels will end up hitting the water or land in storage. Now let's take a closer look at a few of the more niche crude export markets. Africa's crude and condensate exports declined in January after peak exports in December. Now this is likely a one-off. However, declines were seen from Nigeria, Angola, and Libya, with higher volumes overall headed to Europe. And now let's move on to Kuwait's crude and condensate exports, which have declined to Asia, hitting a multi-year low of 1.2 million barrels per day in January, or down 25% year on year. As the country continues to cut back its exports for Al Zour refinery's ramp up, Al Zour refinery reached full production in December after recovering from unplanned shutdowns, and has seen refined product exports rising sharply in January. Now, where are the clean products going? Kuwait's diesel and gas oil exports to Africa more than doubled month on month in January. Meanwhile, naphtha and jet kero exports to Asia also rose month on month. Now, Kuwait's crude exports are expected to remain flat to down in the months ahead, with possible further upsides from its refined product exports. Growing exports of Kuwaiti crude to the Middle East in the gold-stacked bar have been driven by the ramp-up of Oman's Duqm refinery, which is also KPI part owner. Moving to Saudi Arabia, an interesting development. Now, with the ongoing Red Sea tensions, rising volumes of crude have been loaded from Saudi Arabia's Red Sea, mostly Yanbu, in January. Loading from Yanbu rather than Ras Tanura or Jumeirah means that crude bound for the west of Suez markets can sell through the Suez, discharge in Ain Shukna for City Career Reload, all of which avoid the Bab el-Mandeb Straits or a lengthy voyage around the Cape of Good Hope. Now, Saudi exports from the Middle East Gulf overall have been stable month on month. Now let's look at updates from the United Arab Emirates. Divergence has grown in January amid media reports that the crude flexibility program at the Ruwais refinery is making progress. And we can see through our data that seaborne crude arrivals into the refinery have also pivoted increasingly towards the heavier Upper Zakum crude, also supporting higher Murban exports going forward. Now, the crude flexibility project has significantly enhanced the processing capabilities of the ADNOC refinery in Ruwais. It once predominantly refined Murban crude, especially from its onshore fields in Abu Dhabi, but now it can process heavier grades and will likely do so going forward. Now, a sneak peek into the change in vessel operators after Urals traded over the price cap. As you can see, Greek operators' share of Urals trade has declined sharply over the past 2 months compared to the period when Urals was below the price cap. Now, finally, let's take a look at PADD 3 clean product exports in January. Here you can see the US Gulf Coast continues to export high volume of clean, refined products, although diesel cargoes to core European countries soften. Now, PADD 3 diesel is attractive to European buyers due to the ability to make winter spec diesel and shorter voyage time to other resupply points. Another driving factor pushing higher US diesel exports to Europe has been the ongoing Panama Canal drought, dropping water levels and restricting vessel transits. Now, European diesel imports from the Middle East and Asia are now taking longer to arrive in Europe, with most recently the ARB from east of Suez into Europe being closed, especially due to the high freight cost and moving the long way around the Cape of Good Hope. Also, we've seen a higher increase in diesel demand in Asia. Well, that is all we have for you for the February edition of the US Energy Insights. Before you go, we would like to invite you to our IE Week event on Tuesday, February 27th in London. The details are below. Please feel free to go to our website to register. It's under Community and Events. Thank you for watching.